Live from the Financial Things studios is the Peer-to-Peer Lending Essentials podcast.
Welcome to the Financial Thing Peer-to-Peer Lending Essentials podcast. I'm your host, Lawrence Samuels, and this podcast keeps you up to date on the latest happenings in the peer-to-peer crowdfunding and DIY investment world. I'm very excited to have a special guest today. We have Stuart Law, who is the CEO of Assetz Capital. I hope it's a company that you've either invested in or looked into investing. It's one I personally invest in and recommend. I really like what Assetz Capital are doing. I'm excited to have Stuart today with us. How are you doing today, Stuart?
Hi, doing great, thank you. Just working from home in my home office today.
Is that something you get to do often, or?
No. Good thinking time, though.
That is good thinking time. You're based in London, correct?
London and Manchester. The head office is in Manchester in the UK, which is pretty much in the middle. Our team is based all over the country, pretty much equally from the south coast up into Scotland. And we have a London office as well, yes, and an Edinburgh office while we're at it. Although talk of the referendum splitting off Scotland is always interesting.
I was reading a little bit of the bio on your website, and it said that you were previously a business owner. Would you mind sharing a little bit about what you did business-wise before you did Assetz?
Certainly, yeah. Well, I've been in business since 18. Run a software company at university, designed software, sold software internationally, and I've worked in technology for a very long time. Although our CTO is actually a software author, Chris Mellish, who originally wrote the first generation funding circle system as it happens. So no, I didn't have the pleasure of writing our software, but regularly involved in the specifications and driving that forwards. I've worked in property and finance, still have shareholdings in quite a number of those businesses. But Assetz Capital is where I work, and that's the business that I'm the CEO of.
When did this idea of starting Assetz Capital actually come together for you?
Well, the working title was Gap Capital, but even that followed on from a lot of work in the marketplace. In our property business, we had tens of thousands of private investors who were looking for a way to invest a little bit more hands-off into property, and that's not an easy matter in the UK regulatory system or any other for that matter, particularly the States as well. And then along came peer-to-peer regulation, or at the time lack of it, and I could see the direction of travel it was going in, and it seemed to me to be the answer to be able to more easily introduce simple property investments to people without over complex regulation that prevented you from talking to them, even about the simplest propositions. So we watched this for a while. We watched Zopa starting up sometime before we got active with Assetz Capital. We watched a few other people set up, and we noticed there wasn't really any real activity in the secured lending side, which was our speciality. Our Assetz property business, which goes back to the 90s, serves the private investor community and is all about individual residential properties providing significant capital security whilst producing a very healthy yield. And really, secured peer-to-peer lending is pretty much the same concept. We offer secured business loans, principally taking property security and providing, therefore, a significant amount of capital security implicit in the loan, combined with a healthy yield. In the case of our lending through Assetz Capital, you don't get exposure to capital gains, and in a very, very bad situation, you might get some exposure to losses, but with hard security, real estate security, that's minimised. Our average loan book, for example, is only 63% loan to value. Whereas in a residential, in the UK terminology, buy-to-let investment, a residential investment, you've got the ups and downs of capital as well as your income. And we found that Assetz Capital gives people strong income, but without too much probability of any capital loss.
What you did with creating this company is, to me, is obviously a big project. This is not a small project, creating a peer-to-peer company. You've got two sides to keep happy. You've got your lenders and you've got your borrowers. And we all know lenders can be a little bit fickle sometimes. When things go bad, they can be very quick to jump ship. And also, I noticed you have a very experienced team, it seems like, working with you. Where did the team come from that you assembled? Mr. Holgate, for instance, is that somebody that you knew previously?
Yes, yeah, you're right. We set up the business. We had a substantial amount of capital go into the business. We've invested $10 million to date, about £6 million or so. And that took us through to profitability, cash flow profitability, as well as paper profitability. And we set out from day one, although I've already mentioned Chris Mellish, who's our CTO, we definitely started with substantial balance in the fintech. The fin part was because we hired a series of banking and finance and credit professionals from day one. So we didn't try to learn credit or invent new credit and write some software to test it using lenders' funds and hope it all worked out. We didn't take that approach at all. We started straight away by lending, using traditional credit skills. And the team came in, Andy Holgate came in from RBS, the country's biggest business bank, for example. Andy Shepherd, who's our compliance guy. I think we were probably the only platform to hire a full-time head of compliance from pretty much day one, because we could see the FCA coming in due course, even though there was no FCA regulation when we started. We wanted to be ready, and that's borne fruit. David Penston came in from a merchant bank called Singer and Friedlander, a career property banker with years of, I don't want to make him sound older than he is, but decades of experience in property lending. And property lending is not easy. It sounds easy, but to get it right and to know where the risks are, you really need to have seen it all. And he has, and he's very practical. In fact, that's really the approach we take with all borrowers. Our lending methodology is incredibly straightforward at a distance. The devil's in the detail, of course, in credit, but the methodology is simple. We look from an ethical stance to make sure that borrowers can afford the loan and afford to pay us back and are generating the cash flows, or have the exit to pay back a bridge, for example, if it was a bridge, or pay back the bullet in 5 years' time if it's only a partially amortizing loan. So we look for affordability, and then if we think they're in reasonable circumstances going to pay us back, no problem. Just in case they don't, we look for the security as well. And it's hard security, it's real estate security usually, and that's just as the fallback position. And that skill in being practical, in being open-minded, and helping a borrower put together an affordable loan which you know they're likely to repay and that doesn't overburden them, that comes from experience. And we've just hired lots and lots of the best people we can find from the credit and banking industry, which, as that industry's been shrinking, the banking industry here in the UK, like many parts of the world, we've been a welcome open door for people to move over to. And we've just recently hired Rob Palin, who was the Chief Operating Officer of Williams & Glyn, a multi-billion offshoot of RBS that was under European law supposed to be spun off, but they just renegotiated with the government here to give up on that. It just proved too difficult with the software in particular. So Rob's come over and joined us, for example. So we've got some very, very senior, highly experienced lending professionals in the team who look after people's money. It's what we do. If we don't look after people's money, we know what happens, and you lose your reputation. So it's number one priority. We lend it as if it's our own, but we are a traditional peer-to-peer lender where we connect multitudes of lenders with a single borrower. But the secret's in our software. Our software makes it look simple, but it isn't. Getting that right. So it means borrowers don't have to worry too much about how we're going to fund it. The lenders are there. Let's just put it that way. There's huge demand, and we're in cash at any given time, ready to fund the next loans. And we've just used software as our critical success factor to bring down our cost of capital and make lending look easy, even though it isn't, of course, and we all know that.
Definitely not an easy thing. I get a lot of emails from people that are over in the US about some of these companies that they would like to invest in. Is Assetz Capital one that American people can invest in, or are you closed off to the Americans?
We're open to international investors. We have fairly robust money laundering, ID checks, but we can carry those out internationally. So we've got plenty of international investors, corporate investors international. It's one of the nice benefits of being based here in the UK is the FCA's open approach, even before regulation, in fact, to the retail investor. We've not had this limitation on sophisticated investors or high net worth investors, as we call the two categories in the UK, certified investors, etc., in the States. So we've not had that limitation, but with that opportunity comes the responsibility. If you mess about with retail investor money, then your reputation's finished in the UK pretty quickly. So I think we've been as careful with somebody investing £100 here in the UK on the platform on the software as with somebody who's invested multi-millions. But yeah, we're open to international investors, absolutely.
That's a good thing. A lot of the readers are going to be really happy to hear that, because most of them just assume that the UK does not allow overseas, especially the Americans, thanks to the American government and all the problems they've had here. So
yes, yeah.
they'll be glad to hear that. Okay.
Yes. Indeed.
So I think that one of the things that peer-to-peer lenders tend to overlook is the experience of the directors and the staff that are running these companies, and sometimes they focus very much on the loan quality and the interest rates that the loans are paying. Do you think this is a bit of a problem, that the lenders are focusing too much on the actual product versus the people that are running the companies? Because obviously, as you know, if the platform fails, what good are the loans anyways at the end of the day? What's your thoughts on that?
Yeah, I think it's completely interconnected. In the end, the people will drive the loan book. So the people will get the loan book, the people running the business will get the loan book that they seek. And so it's a very difficult balance, because without taking some risk in lending, you won't get a coupon. Without any risk at all, in the UK, for example, a borrower would, with a fantastic multi-decade track record and fantastic security, would typically, as long as they have no credit issues at all, would typically be able to get funding from a high street bank at a few % per annum. We don't extend up into the same percentage returns that you can get in the States for unsecured business lending, which I hear are sort of well north of 10% and up into 20s and 30s before they start hitting the local state caps, etc. Those types of returns we don't operate in, and to be frank, we don't need to. We take security, and we're achieving typically for lenders between 8 and 12% per annum. And you're right, the high interest rates attract people, and I think it's human nature. Humans like to get a great return, but we notice they talk themselves into why there's no risk involved at that level of return. They ask the wrong questions. They ask all the positive questions and don't dig deeply. I think that's a bit dangerous, because all lending is not the same. It's take something as simple as a bridging loan, where you imagine that you've got 60% loan to value, and what can the problem be? How bad can it be? Well, that 60% loan to value bridge may have on top of it interest that you've retained and that you've lent to the borrower. So maybe now you're at 70%. And what happens if that bridge is unrefinanceable when you get to the end of that year? Fine, you can refinance it on the platform, but by another year's time, you're up at 80% of loan to value. By this point, that loan is pretty much unrefinanceable. There's no other lender in the market who's going to take it. So you're really then looking for a sale. But if that loan was to somebody seeking planning permission, by this point, if they haven't got planning, you're very much deep in a hole. And if you have now proven you can't get planning on that site, perhaps the valuation has just lost its hope value. And so this is about having the experience to recognize what you're getting into. It's the age-old thing. Everybody says it, or should be saying it. Very easy to lend, very hard to get it back. So we always look at the exit and how are we going to get the money back in the real world, particularly dangerous with bullet loans. So yeah, we know that returns in the UK can be lower than the States, but it's interesting to watch some of the bigger players. If you look at the recent announcements from the world's biggest investment trust, P2PGI, the specialist P2P investment fund, for example, and VPC's Victory Park's public troubles with lending and decisions to change direction a little. These difficulties have come from seeking yield at higher returns, where perhaps everything just didn't pan out the way it was supposed to pan out, and they've reassessed which platforms they're going to lend through and change their model a bit, and that's not to be too surprised about. I think high yield tells you where the risks are, even if you can't see them. I think that's the issue, because if it was low yield, it's because somebody's willing to give them the money cheaper. Nobody pays over the odds. So if the yield is high, it's because there's something somebody else knows that means they're not going to give them the loan at a lower rate.
Stuart, you've been to Ireland before, right?
Yeah, been to Ireland a few times, and yeah, both before and after the crisis.
So, about 2 weeks ago, I was in Ireland, in Dublin, and I was walking down the road, and it was raining really, really heavily. And I stopped outside this pub, and I saw this old man, and he had a fishing rod, and he was fishing in this really shallow puddle. And I felt really sorry for him, and I thought, oh, I need to buy this person a drink. So I bought him a drink, took him inside, bought him a whiskey. And while he was sipping his whiskey, I thought, I better have a conversation with him. He was kind of quiet. And I said, sir, how many fish have you caught fishing in that puddle outside? And he said, oh, you're the 8th one today. Get it? No?
Yes, I do. I do.
I just thought I would throw you off with a joke there in the middle of it. Okay.
No, that's good.
That's a little bit of Irish humor there for you.
Sounds like the Irish as well. Yeah, absolutely.
So, Stuart, I personally believe that peer-to-peer company failure is the single biggest risk to lenders. If a company fails, there's just so many unknowns about how lenders would get their money back, if they would, how much the administrative costs will be. And I also think it's important for a peer-to-peer company to be able to operate profitably. How is Assetz set when it comes to operating profitably? Is your company actually profitable right now?
It is, yes. Yeah, we've been trading since April 13. We have run through a period of fairly substantial cash burn, cash investment in the early years. But by the time we came into 2016, we had our model very much sorted. And Q4 of 2016, we made around £1 million in that quarter, which is pretty healthy, pretty strong. We're one of the first to come through into profit, but you have to be very careful about the word profit. Plenty of people have contracted future income or contracted current income that isn't yet paid from lending. So what I'm talking about is £1 million of cash flow profitability, hard cash generation. We were more profitable than that from a paper P&L point of view, but I don't like to do that. I've been in business since I was 18. Let's just, without doing the maths too easily, but making it fairly easy, I've been in business for about 35 years. Cash is king. So we've been very focused on building a business which is very cash generative. And therefore, your main focus once you've done that is just to build the volume. And we're one of the few that's reached. My metaphor is reaching the crest of a hill. You can almost make it to the top of a hill. If you don't have enough funding, you can just roll all the way back down to the bottom. But we've gone over the top of that hill. We're into strong cash generation, strong profitability, strong gross margins, as well as strong net margins. And we're doing that in a competitive environment. So yeah, we're looking at very, very substantial profitability now going forwards from where we are today, and it's a very tough gig to do that. Some people recently in the last week or two have talked about one is closing down and selling off its assets, for example, having run off its loan book. Quite a well-known brand. Which was in the press just last week, Trillion, and I think they were quoted as saying you need about £100 million loan book, $150 million loan book, just to roughly break even. I think if you've got that with some new lending, that's probably about it. But that's a tough hill to hit and get over the top of. Very tough, and I just don't know how you can do it on a small scale, because regulatory costs, software costs, sales costs, the costs go on and on and on and on. You just can't do that without scale or without extremely deep funding pockets. Although we've done quite well, we'll probably lend between 250 and 350 million sterling, getting on for $500 million of lending this year, and we've done that from a £6 million equity investment, which is testament to the team's focus, hard work, and very careful cost control.
Your financing for the company, were you ever venture capital funded?
We had some we put some seed funding in. My family put some seed funding in. We then took, strangely enough, some crowdfunded equity. Our lenders wanted to know if they could have access, and we suspected that in the future that might get difficult. So we let about £3 million sterling in from the crowd, and we've had a little bit of more funding as well from the industry, as it were, without naming names. Strong players in the market have taken a small stake in us, and now we're looking at moving to the next level. So, it wouldn't be too surprising to see a significant equity investment this year in order to really finish off our, not for funding of cash burn, of course, but to finish off our stability, our capitalization, to really take us through to the next level, because we're aiming to have a £1 billion loan book, active loan book, by around end of 2019. And that'll take some funding to do. So we're fully retail funded pretty much at the moment. So all of our 220 million sterling, $300 million of lending so far has come principally from retail lenders. But I think in the future there'll be some other lending sources coming in if we're to hit those sorts of larger numbers in the next year or two.
It sounds like you have a good financial cushion. That's good to hear. With what's happened with the interest rates obviously having dropped quite significantly over the last couple of years, where do you see lenders' interest rate returns heading into the next 12 months? Do you feel like they will stay at the same levels, or are you prepared for a drop in those?
Yeah, if you look at the charts, we look at all of the aggregators of data. There aren't that many of them, but altfi.com is one with their data. And we look at that. We look at other hints and so on in the marketplace. We're seeing pressure downwards on lender rates, particularly in consumer lending. Consumer lending in the UK is very, very competitive. It's not a market we're in, but we're seeing prime lending into consumers here in the UK down at about 3% per annum borrower rate. Now, you can't pay lenders 6%, 10% when you're doing that. So we're seeing substantial downward pressure caused by competition, would you believe it, with banks. Banks haven't left consumer space. So that's proving to be very, very difficult. It's an area we consciously avoided from day one, and it's becoming extremely competitive. And that's definitely pushed rates down to 2-point-something% for lenders who want access to prime consumer debt. In the business market, we're seeing banks cherry picking, let's call it that, funding good quality customers, the very, very best, who tick all of the boxes and who can achieve that kind of coupon. And we're seeing those still being funded by banks, but small, medium-sized enterprises, SMEs, with anything at all that needs a bit of work or a bit of consideration, are finding it really tough to get the funding. So we're not seeing particularly much pressure downwards on those rates at the moment, and hence we're not seeing much pressure down on the lender rates that can be earned. So I would expect that in the near future we're going to see in the UK with Brexit, I think for financial support of the country, we're going to carry on seeing very low interest rates for the foreseeable future. Black swan events excluded, one that might take rates up rather than down. It is still entirely possible we could see effectively negative interest rates here in the UK. So I see the bank base rate not particularly helping push up lender rates. Because it won't be taking that direction of travel, I suspect. Equally, we're not seeing over competition in the property and the business lending sectors. And what I mean by that is we're not seeing people trying to push rates down to incorrect levels. I think one risk that we had in the beginning with peer-to-peer was that platforms were going to let individual investors and lenders actually set interest rates themselves, which was a really nice idea and a really bad one at the same time. Letting individual lenders just bid prices down when there was very little choice as to where to put your money to get a decent return was a bad move. So most platforms have moved to pricing loans independently. Now that's important. So you've now got the loan platforms judging the rates, and that's put a bit of a brake on too much money trying to find a home that pays a coupon, pays a yield, forcing rates down itself. But nonetheless, there are still pressures, I would say, that outweigh pressures downwards, that outweigh the pressures upwards on rates. So the risk is that rates go to inappropriately low levels. if we carry on at these low base rate levels, and if we carry on people putting too much money into places where they can still get a return. We've seen it with Zopa, for example, here in the UK, where they gate investor ability to put more cash onto the platform in order to avoid too much lender side imbalance driving rates down.
Your overall view that you think over the next 12 months that the rates on Assetz Capital for lenders are going to remain what they have been?
We think they will. Yeah, we're not a very simple platform. We offer people a bit of choice. We offer accounts which have liquidity built into them to a significant degree in normal market conditions, and those pay a lower rate. So we have accounts that pay 3.75% that give you the best possible chance of instant liquidity in normal situations. We have accounts which you can just go into and wait for the loans to repay, and then you have a chance to sell them on the secondary market, but by default you're going into it for the 3 years, 5 years, 12 months for each of those loans. And those accounts pay about 7, 8, 9%. So you're talking about a range from 3.5% to about 9, 10% on different accounts we offer. I think if anything, we'll see the middle to higher end of those rates just compress a little. Because we want to be attracting the highest quality credit that still has a small degree of risk. In our business, there's a difference between risk and losing capital. Risk of default with secured lending is risk that we'll end up having to do a whole load of work to get all the money back. But because we're secured, we would have an expectation of recovering most or all of that cash in all normal situations. So our expected loss rate, if you were to represent it as an effect on your coupon, for an unprotected account, an account that doesn't have a provision fund to cover those losses. So for an unprotected account, our approximate figures are sub 0.5% per annum reduction in your coupon. That's really where we are, and that's principally because our loan's secured.
I've noticed that the peer-to-peer lending crowd tends to be very quick to jump on changes, especially in interest rates. They can be a very fickle bunch. They can exit platforms very quickly if they feel that things are not going the way that they want them to. And I know Assetz definitely, from what I've read, has taken a little bit of heat in the past over, things that are obviously market controlled. Things like the interest rates being reduced. How do you keep the balance about keeping the lenders happy on that end? Because you've got to keep the borrowers happy. You have to keep the lenders happy. It's not like a normal business where you've just got one side. You have to keep both happy. How do you balance that and keep those lenders happy?
You do. It's in fact that's one of our specific pieces of IP. Without going into the exact mechanics, we have buffer systems that smooth that direct relationship. So our lenders most definitely invest in individual borrower loans. That's a given. I say it's a given. It's very important. It's how the regulation is in the UK. But we also have buffer systems which we've developed in-house that operate to smooth that supply-demand imbalance a little. And so the minute you disconnect those ever so slightly while still staying within the regulation 100%, very far from the line, nice safe place, you can create a better experience for the lenders and a better experience for the borrowers. So cash drag, for example, you can end up with platforms taking too much cash on the platform. The effective return you've got on the total cash there, because some of it's invested, some isn't, comes down. So your headline rate isn't actually being achieved. We have a number of accounts which pay the headline rate and have done since the beginning. And whilst there is a risk they won't, we've never been anywhere near that situation. So we have a number of accounts which pay what it says on the tin, whereas traditional peer-to-peer early stage platforms had a significant cash drag that dragged down your returns because not all your cash was invested in loans. That's still the case in our highest paying accounts where you manually choose loans to invest in. But our lower rate accounts, we've eliminated that cash drag, and it's little things like that you can do for both borrowers and lenders that improve the smoothness of the interface, the experience that lenders have and borrowers have as well. And it's important to invest in that tech. The simplest of platforms can't do that. it's really expensive tech to do that. Very, very, and particularly to be compliant.
That follows on to the next topic that I was going to ask you about, and just to sidestep, I was very, very impressed when you, as a company, introduced the account that would drip into, if you were investing manually and you had some cash left over, that it would automatically drip into the lower paying account. I thought that was very innovative and impressive. As far as tech goes, the tech costs must be substantial into a company of your size and what you do. How expensive is it to develop a tech system like the one that Assetz uses? Is that a big burden on your financial resources?
I hate to think what it would have cost if we'd bought it in. All important things in Assetz Capital are in-house. If there's one thing I've learned, put your mission critical stuff in-house. So we've never subcontracted the software, not from day one, which is a luxury that's less painful to afford than paying a third party. I mean, you can just imagine, can't you, building a very high-tech platform using a team out in Eastern Europe, and does the thing ever, leak to other platforms and other people? Who knows? Who knows what happens to your software if you develop it outside? So all of our IP is in-house, and it's not been a huge burden on the company, no. But it's millions of pounds worth of software. We could have easily blown half of our entire equity or more just on a software budget if we had bought that in. And I'm sure we'd be seeing some of the features in other platforms as well by now as well.
Yeah, you definitely have features that nobody else has. So, Stuart, what is the single biggest challenge, the one thing that's the biggest headache for you as a peer-to-peer company?
It's I think the days of that have gone. We've had big challenges with getting enough lenders, big challenges with getting enough borrowers, big challenges with almost everything, getting the software out on time. But that was the first 3 or 4 years. We've now got a much more level playing field of challenges. So we always want software a bit faster, but we don't have any key issues with that. We would like a bit more lender funds, but actually not too much. More borrowers. We're growing at about 300% per annum. Last year we lent about 110 million pounds sterling. In the last quarter or so, we've done about 45 million. So our growth rate is heading, maintaining really, as it always has been, to be about 300% per annum. So we expect to go from 110 million last year to 250, 300 this year. That 300 might be 600, 700 next year, and so on. So steady growth is actually your biggest challenge. And we've got to the point where we've got enough scale so that the diversified sourcing of loans, the diversified sourcing of lender funds to fund those loans has got some balance in it now. So I think our challenge now is to just keep doing all the right things and not forget about any of them. We're doing them all. For example, we're hiring because our average loan size is around getting on for £1 million. For example, we've got to meet customers. That's the bit of fintech that isn't very tech. We've got tech supporting those people in the field, but you've got to go and see people you're going to give £1 million to. Even if you're taking security, things happen with security sometimes as well. So you've got to go and see the people. So I think the biggest challenge this year, which we'll achieve, but it's a challenge, is hiring in perhaps another 20, 30, 40 of the country's best relationship managers who can go and vet those customers face to face. We want the best of the best that we can find, and it's working. We're hiring at a significant rate, but I think that'll be the challenge. It's tough getting the best people to leave good, steady jobs and move over to us and abandon all those bank income schemes, etc. But they are doing so, and we just want to accelerate it.
Without getting into the specifics of the FCA, which I know has been a big headache for many peer-to-peer companies, do you have any idea about full authorization and ISA offerings as to when that will occur with Assetz?
We just don't know of anything that's left. We don't have any questions on the desk at our end, so it could happen tomorrow. We are, of course, one of the biggest platforms. So there's only a handful of big platforms in the UK. five or six roughly, and we're one of those. So I think we all seem to be in the same box, and they're running slide rules over stuff. But we just haven't had any material questions for so long now that all I can think is we're about to get permissions. I think some of the larger platforms let loose too fast in ISA season might cause a problem. ISAs here in the UK are the tax-free savings accounts, and they come in waves. So we're about to hit the end of this tax year. So perhaps everything's just being parked for another week or two, so that none of the big players can launch an ISA this tax year whilst the rush is on, and we can then have less of a cash impact. Going back to your question about what could affect lender returns, too much cash absolutely could. And ISAs here in the UK have about £500 billion of cash in them. Half of it's invested in stocks and shares, half of it's in pure cash. So £250 billion of pure cash, earning probably well under 1% for most people per annum. That's a flood you can probably do without. So whether it's before or after the tax year, which in the UK is April the 5th, it's probably a little bit better to be after. So I'd like to think everybody's about to come through, the big players, just after April the 5th.
So right now you're in a constant holding pattern flying above Gatwick Airport, and you don't know when you're going to be able to land.
Yep.
So the biggest question, Stuart, that I get emailed for readers of the website Financial Thing is risk. They want to know how risky is peer-to-peer lending. So first question for you is, what do you think it's going to take for peer-to-peer lending to become more widely recognized and accepted as a viable form of an investment for somebody, your average Joe on the street? What will it take to get to that point?
A number of things, I think. Scale is one, a moderately important factor. The one that's always quoted more as an excuse, I think, than as a true reason, is waiting for the next cycle, see who's left standing. It'll certainly show who didn't have proper security or who didn't have a realistic view on their defaults and recovery levels. So I think that's something that we're quite comfortable with because of we've stress tested our portfolio, and it's a nice job to do that when you have such good property security behind your loans. So we can stress test, and we have negligible issues. It's all posted in fine detail upon our defaults and losses analysis page on our website. But I think that's the point about the next cycle. Coming through the next recession, the next cycle will show who was optimistic about their default levels, who was optimistic about their recovery levels when they do default, and who took really robust security and who didn't. There's security and security. If you're taking security, a mortgage over a piece of property, that's fine, unless, of course, it turns out there were title issues with that security. These are the things that take time, and I think it's little things like, are we competing on how fast can we put a bridge out? Can we do a bridge in 2 days? If you do, there are ways and means of mitigating the risk of title on the security, but are people doing it? Are they doing it right? And is it something you can rely on the next cycle? We all know about big institutions just falling over and running away from their liabilities last cycle, and insurance, for example, to give you title insurance so that you can lend very, very quickly without doing the proper searches, is all well and good in normal conditions. How will that do in the next cycle? So we're very, very aware of all of these issues, and we prefer to walk, not run. We prefer just to triple check, not just double check, and it makes us sleep better at night and our lenders better at night. You mentioned a bit earlier, we've had a few buffets and waves as we've gone along, because we've gone from zero lending to 220 million in times when others have gone from 0 to 5 million and others have gone from 0 to 1 billion or more. We just feel we're going at the right pace, and we're taking the right security, we're taking the right checks and measures. Our credit team is immense. Our credit team is about half the size of our sales team.
Wow,
Think about that for a moment.
That's big.
This is proper. We're monitoring. I've seen platforms send out letters saying, "Oh, we forgot to do the monitoring. We noticed there was a covenant in your loan. Could you send us your accounts, please?" we're on that every 30 days. We're monitoring. We've got a lot of pre-monitoring going on to try to spot issues arising before defaults arise, and that's all very labor intensive. So I think, back to your question, what do people go? What's it going to take for people to invest in this mass market? I think it's scale. It's coming through the next cycle. It's seeing lots of other big names co-investing. So if we're lending out lots of big investment firms money that are high street recognizable, that would help. There's a lot of little things, little factors, but time is the big healer. But eventually time will take you into another cycle, into another recession as well. So time is great until that moment, and then last man standing, I'm afraid, after that. And that's the ultimate test, isn't it?
Stuart, so I'm going to put you on the spot with regards to risk. When I do my analysis of companies on my website, I have my own personal risk number that I place on a company, and that comes from my own experience lending, what I know about the company accounts, which is very subjective. And I like to put a risk number on what I believe a peer-to-peer company is for myself. If you were to look at Assetz Capital and you were to say, I'm going to put a risk number on Assetz Capital, like how risky is it to invest in assets? And you were to place a number between 1 and 10, 10 being the riskiest, 1 being very little risk. Where would you personally put assets on that risk scale between 1 to 10?
Well, I know where my mother's put me, down at 1. But also you can look at we've been around long enough now to be able to show recovery rates and losses from defaults. Defaults is part of the picture, but as I said at the beginning, you've got to take some risk to get healthy returns. The key question is, can you get your money back if it goes wrong? And I think we've proven that we're getting an awful lot of the money back. In the first 9, I think maybe now 10 loans that we've fully completed the recovery process on, we recovered 100% of capital and interest. There'll be losses. There are definitely some expected losses in there, but they're measured in around the £1 million level from £220 million lent and from about £20 million of interest earned. So you look at very big headline figures like that, and you look at the hard property security we take with a 60-odd% loan to value average. We never typically go above 70, for example, and very rarely, and quite a lot of our loans are sub 50. So when you put all that together and the experience of the team, I'm definitely down at that number 1, because when you get to a cycle, you've got to have hard security with a modest loan to value to come through that the other side. It's all well and good, if you measure your recoveries on defaults. So let's say you're doing unsecured lending and you've got currently, a 5% default rate, and you're recovering about 30% of those. When we go into a recession, we all know in business lending that's going to head off towards 15-20% default rate. Your recoveries team is going to be flooded with recovery hassle and difficulty of getting, and so your recovery rate's going to go down. With our business, that's just not the same, and many of the assets we're lending on are income producing. Many of the assets are residential properties with a well-known UK shortage of housing, and you can say that's theory, but when you go back to the last recession, there was a wobble in house prices, in residential prices, but rents went through the roof through the recession because there's an underlying lack of property supply here. So we take a lot of residential security, and that gives us a lot of comfort that we're going to have income production even in a recession from those base assets, even if we end up owning them temporarily on behalf of our lenders.
On the record, then, you heard that Stuart says that Assetz Capital, in his mind, I'm sure that he's going to be a little bit biased, but I totally respect that, believes that on a scale of 1 to 10 risk, the Assetz is probably one of the least risky peer-to-peer companies in his opinion that you can invest in. So if that gives you any more comfort,
and that is an important distinction. Yeah, in the peer-to-peer world, we're talking about that. If you're talking cash versus peer-to-peer,
no comparison,
then of course there's a gap.
Absolutely,
there's a gap. But without some risk, which in our case is very well managed, you just won't get a return, will you?
That brings me to my next question. Obviously, you've got these ISAs with these huge amounts of stocks and shares inside of them. If you were to look at an average investor, they would ask you, well, why would I put my money into peer-to-peer lending versus, say, into a tracker fund in the US or a tracker fund in the UK, what would you tell them as to the reasons why they would want to look at peer-to-peer lending as a way to diversify away from maybe stocks and shares a little bit?
It's a very simple paradigm that we use. Very simple. Cash is with a bank in normal market conditions, again, is very simple security of capital. It's about as guaranteed as it gets unless you have too much money in the bank. So it's about as safe as it gets with an extremely modest coupon to reflect that security. But stocks and shares, tracker funds and so on, they're called investments, but I think I've got quite a harsh view on the word investment, and I call stocks and shares speculation, because you're hoping prices will rise. Now, if you're Warren Buffett, you'll have done your maths and you'll have a very strong probability that it will rise in the medium term to long term. But in the very short term, stocks and shares are a gamble that they will go up. You know, you look at people arguing over whether to go on one platform or another for 4% or 7% or 10% per annum. But in the stock market, we've seen that up, 20% or so this year. But if you look long term, it's barely up in the last 15, 20 years. It's because it goes up and down by tens of percent. So capital security in the stock market and in funds, for that matter, most funds anyway, capital security just isn't there. If we told, as a peer-to-peer industry people, that their cash balance would go up and down, their security level would go up and down by 10, 20% a year, we wouldn't see them for dust, would we? And yet that's what people face in the stock market, and somehow they're blind to it or used to it. So I would definitely place particularly secured peer-to-peer lending, but also heavily diversified unsecured lending with good platforms. I would place that between the two markets. I think I was probably the first person to explain it as a triangle. You've got traditionally cash, super capital security, very modest income. Stocks and shares, a mix of a bit of income and some significant capital risk and return exposure. Whereas peer-to-peer lending, either heavily diversified or secured like we are, is a middle ground. It's great capital security, very difficult to lose material money with a good platform with good security or good diversification, but also with a healthy coupon. So we think it sits very, very well with that range, and I don't think anybody should have all their eggs in one basket. But what do they say about people who gradually go through the years and get older? Start off with your speculation. Stock market is difficult to beat, apart from property perhaps, when you're very young. But the older you get, you need to protect your capital. So a blend heading in the direction of secured income producing assets is definitely the right thing to be doing. It's what all financial advisors suggest. And peer-to-peer lending can sit in that comfortably as part of a portfolio. So you should definitely be looking at it.
One of the points that I hear a lot from readers of my website is that it's the established age of the peer-to-peer companies that a lot of people are worried about. If somebody invests £100,000 into assets, and assets for some unknown reason goes out of business, they worry about that. They worry about, well, where does that leave them? Whereas the share market, you can say, well, it's a long established 100-year product that, I pretty much know if I put 100,000 into a tracker fund that it's not going to go down to zero. And I think that's one of the biggest concerns.
That's true. That's very true indeed. Yeah, you might lose 10%, 20% of your money because humans don't tend to sell when things go down, and they ride it all the way to the bottom.
Yeah,
that's just human nature, isn't it, with investment? But you're right. A tracker fund, a well-diversified stock market fund, is probably not going to go to zero. No, and I think that's the thing people haven't fully understood yet. And it's not necessarily technically understanding; it's just getting used to the fact it never happens. Will take many years. And it won't happen if you're diversified. We have a backup servicer, as you have to have in UK regulation. And we have 110 million current live loan book. That's throwing off a very, very substantial amount of cash every year to pay for that servicing. So professional servicing company sits in the background to us. It doesn't actually matter in terms of getting your money back, whether we're running that and making that money or whether a third-party servicer takes it over and gets your money back. When you've got scale, it works. But if you've got very little scale, Is it effective for someone to take over that book? More difficult, I think. So yeah, it's about scale, track record, experience. You've got to prod and poke lots of things, and then finally just diversify. Spread your money over the bigger names in the industry, and that's one thing most platforms don't talk about, but it's the right thing to do.
I think that's great advice to it. I think I know what the answer to this is going to be, but I'll ask you anyways. Do you actually personally invest anything in peer-to-peer lending yourself, or does all of your money go into your business?
I'm a business investor, so I do that, but I have an account and I invest, absolutely. And I invest principally, traditionally I was investing in the manual lending market, just buying and holding loans to expiry when I had the time, but I began to run out of time and there was a lot of competition for those loans and I wasn't quickest off the mark in getting into them, so I began to give up on the manual investing. I started putting it into the automatic accounts, so it was more hands off, but yeah, obviously I'm mostly invested in my businesses.
And it's safe to say that you personally don't invest in other peer-to-peer companies, correct?
No, I haven't never got round to it. No, we have plenty of accounts open with the competition to see what they're up to, see if they've invented something that's new and safer and nicer. But no, we've not really seen that.
Okay, well that's good to know. I thought I would ask anyways because you always get a range of different answers from people. Would you care to share, Stuart, on any Assetz Capital plans, maybe future innovative products that you might have upcoming? Anything that you'd like to tell the listeners about?
Yeah, I think what we live in here in a peer-to-peer world, in a marketplace lending world, but one that's aimed at retail investors in particular, individuals, whether they're high net worth or not, is a world where people are finding a home for their money, and it's producing cash flows, it's producing income. We're getting people paying back the loans steadily or at the end of the term. And so there's a lot of cash moving around. And when you also look after a very large asset base, it's pretty obvious. You've got a lot of cash flow generation, a lot of security, a lot of assets throwing off cash. Those sorts of base assets are very much the building blocks of a lot of financial products. So I don't doubt that just like you're seeing lots of new startups moving into very simple areas like international currency transfer and payment card services and so on, you can certainly expect to see us offering some more products and services in the future to offer a fuller service to our lenders. And you're seeing quite a few platforms, not necessarily peer-to-peer platforms, but quite a few fintech platforms doing that. In the UK, there's a big rush on, for example, app banking. So banking license, new banking licenses typically going to new startup banks who are principally going to be based on phones, app-based banking. And, it's interesting to watch that progression. We're certainly working on a number of projects with those types of players, and you'll be expecting to see some stuff pretty shortly, I think, on that. And I think the whole fintech world joining up and offering a rounded experience to retail investors in particular is definitely what you're going to see more of going forwards. And we'll also be offering substantial services to the business borrowers we have as well, but there's far more lenders. We've got getting on for 20,000 of those.
Wow, that's a big number. Personally, I would like to tell you, Stuart, that again, I'm a big fan of what you're doing.
Thank you.
I hope you continue to have success in a very innovative field, and I think you're a very innovative company. You have a lot of advantages that a lot of the other peer-to-peer companies aren't able to offer it. And it sounds like that you have things very well set up on the security side, on your underwriting side. You have an experienced team, and kudos to you for doing that.
Thank you.
And yeah, before we wrap up, is there anything else that you would like to tell people about Assetz Capital and why they would want to consider you as an investment vehicle?
Yeah, I think it's mostly what's been said already. It's keeping things simple. We haven't reinvented credit. We've instead applied technology and simplicity to what is really quite a complicated business. I think just focus on security. Think the big picture. Think the cycle. Just because things are liquid and fantastic today, make sure that the basis of what you're investing in is going to ride through any wave. And just think that through. Think through the basics. And companies that are transparent are definitely the ones to focus on. People who publish their loan book or give it to third parties to be analysed, or give it to ratings platforms, which we've done as well. It's important. It is really important, and transparency in the end, there's plenty of pieces being written on that recently. Transparency is key, and we're very transparent on our defaults and losses, very transparent on the security we take, very transparent on how we do credit, and we're just about to publish our data out into some of the biggest third-party analysts who analyse this marketplace and analyse credit generally. All of the above is important to people, and that's what you should focus on. Just focusing on the coupon, you're going to get trouble.
Yeah, I think that's great advice, Stuart. I'm just going to back up to one other question that I wanted to ask you, and then I will let you go because I'm sure it's dinner time. Well, probably. I recall in the past that Assetz would collect a buffer for each loan. Is that something that Assetz still does now? Because I always found it a little difficult to find that information within each loan, whether there is actually a buffer, whether that buffer was healthy or whether it had run out. Is that something that the Assetz does still on those loans?
Yes, we've gone much more clear and transparent on that now. So you'll find that information in our defaults and losses section. And you'll find it where the stress tests have been carried out. The purpose of what we call a provision fund, how we operate it is we don't provide a piece of cash per loan that would take first loss. Because if that was, say, for example, a bank has enough capital to cover a few percent of its loan book, for example. If we had, say, 5% security piece per loan, what happens if that loan lost 10% in an exceptional situation? It would use up the buffer on that one loan, even though other loans, the buffer was never touched or barely touched. So we took a regulatory compliant approach to have a single fund for a single investment account. In our system, an investment account is a place where you can put money, and in most cases, you agree a mandate for it to invest in certain types of loans in certain ways, and it goes off and does it for you, so you don't have to keep visiting the platform every single day to pick loans. So in that type of investment account, we usually have a provision fund which holds cash for purposes of maintaining any interest cover if somebody was late paying some interest, and also covering capital losses on that book. So it is a provision fund funded by the borrower's coupon, as well as some of our capital in the past as seed funding, to cover any losses of income or capital. And that's our approach to it. And when you go to look at the stress tests, the Bank of England in 2016 launched its most difficult ever stress testing for high street banks here in the UK for their loan books and so on. And we applied the same criteria to our loan book, and we then used that as a way to measure the capitalization level required for those provision funds. So in the worst possible scenario of defaults and losses expected out of that scenario, we have roughly in some of those accounts 3 times coverage, and even if certain other factors kick in above and beyond that, we're still at 1 times coverage. In the worst Bank of England stress test scenario, which is basically Armageddon beyond measure, far, far worse than we saw in 2007, 8, 9. So yeah, that's how we run our provision funds. They're funded out of the coupon the borrower pays, and they cover the set of loans in that investment account for any losses of income or capital. And there's a mathematical formula on the defaults and losses page that explains how it's all calculated, and the type of stress test we've applied.
Stuart, I wanted to thank you personally for coming on the podcast and for letting my readers have an insight into you and what you do. And to everybody that's out there listening, please check out Assetz Capital. I'm going to put a link in the description below if you would like to sign up for a free account. Again, it's somewhere I personally invest my own money. You can read the review on Assetz Capital that I have on the website financialthing.com. So come check out all the reviews and the information that we have there. And hopefully we'll see Assetz do very well in time to come.
Indeed, and we hope to hit our 100 employee level in a few months' time. So getting quite decent scale. Indeed, that's our next celebration milestone.
I look forward to seeing that happen for you, Stuart. So thanks again.
Thank you.
You've been listening to the Financial Thing Peer-to-Peer Lending Essentials podcast. Don't forget to visit financialthing.com for all the latest peer-to-peer lending reviews and DIY investing articles.